This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Nadia Lovell, what's great about Nadia is her water bottle, which you can see on YouTube, Bloomberg Podcast. Nadia, hold up the water bottle. You were hydrating and was going in there. You see how it's matchy-matchy? Look at that. It's matchy-matchy with what she's wearing. It's great. She switches every day to the proper bottle. Nadia Lovell is fabulous on having the courage.
Well, it is Valentine's Day tomorrow.
That's very good.
Perfect.
We'll go there. I forgot, Nadia. Thank you.
Sending you love.
And what's great here about Nadia Lovell, she sends us love on the courage, Paul, to be in the markets.
Absolutely. Nadia Lovell, Senior U.S. Equity Strategist, Global Wealth Management at UBS. So, Nadia, we got this inflation print here this morning, a little bit hotter than expected. The market's selling off here, the S&P off about 1.2%. What did you take away from this? And I guess more importantly, what do you think Fed Chairman Jay Powell's going to take away?
Yes, inflation did come in a little bit hotter than we expected. We were looking for 2.9 on headline and 3.7 on core. But I don't think that this one data point changed the narrative. The Fed has been hinting for some time that March rate hike was off the table. We have been saying for a few months now that we had expected the first the first cut to start in May. I would say that this does put a May cut at risk, just given the strength that we're seeing in the economic data. But I do think that what it does say, though, that the equity market can take some comfort, right, in the fact that you are seeing strong economic growth, and that's what's probably going to cause delay in the rate cuts. And the Fed is on standby at the end of the day with great latitude that if we see any sort of meaningful deterioration in the macro data, which there are no signs of that the Fed can adjust policy very quickly. I don't think at the end of the day, when we have a soft landing in sight, that anyone wants this to dip in a recession. So we think that the Fed will do what's needed to adjust monetary policy accordingly, but it probably does push out the start of the cutting cycle just a little bit.
Paul, Ian Lingan at BMO Capital Markets, a good friend of the show, he says of CPI super core, super high. And that's what Michael McKee does. Yep. When you get the different service sector inflations, they indicated a higher level, and that's where you get to futures from -20 to -63.
Yep.
NASDAQ futures down 1.8%.
Absolutely. So we're seeing a market move here and yields higher. Nadia, so, we're about 70% away through this earnings period right here. What's your takeaway here? How's corporate America doing?
I think corporate America is doing well when you look at the earnings season for the fourth quarter. I mean, companies are beaten. We're seeing earnings trending towards 7% growth for the quarter, which is a little bit better than we had expected. You also see some confirmation from the commentary from companies of what we're seeing in the macro data, sort of some green shoots in the manufacturing areas of the economy. You're seeing a pickup in M&A activity and capital markets activity. So that's quite encouraging. And I think what's more important, though, the full year numbers remain intact with the consensus looking for double-digit earnings growth. We're looking for something roughly in line with that. And I think you're also seeing confirmation of the strength in technology. We know that tech has been a crowded trade, but these companies are really starting to grow into their valuation. Right. So that's quite encouraging as well.
On the equity front, we feel restrictive? One of the great debates here with the real yield, the 10-year real yield out to 2.01%. It's now pulled back. It's 1.98%. Nadia, does the inflation-adjusted oil in the engine, does it begin to gum up and restrict the system?
I don't think so. I mean, the consumer still has a lot of excess savings and corporate balance sheets are remaining strong. And ultimately, the reality is we do think that the Fed is going to cut this year by at least 100 basis points or so. And that should help bring down bond yields. We're looking for the 10-year to end the year at 3.5%. Yes, near term, we're looking for more of a trading range of 3.75 to 4.25. But we think as you get into the back half of the year that yields will start to normalize. And we still expect inflation to remain on that disinflationary trend over the next 6 months, I mean, we think that you'll start to see the slowdown in rents, continued pullback in vehicle prices should also help, and improvement in supply chain should help. So when we get into the back half of the year, we're looking for, inflation to come down to about 2.5%.
All right, given that backdrop here, what do I do with my tech trade? I've been long the Magnificent Seven, leverage long position, and like NVIDIA up another 45% this year. Do I just kind of ride this tech wave here?
We think that you do. I mean, we remain positive on it. I mean, I would say to Tom, who might be still the triple leverage cash. I'm not
cash.
Sure.
Yep.
To take out opportunities and take advantages of any pullback that you might see in tech. You would be surprised to see a little bit of consolidation. But when we look out 6 months to a year from now, we think that this is a sector that's going to be higher. We're looking for, earnings growth within the sector to be in the high teens, and it could even trend into the 20% range. And you'll also see in reality is recovery in some of the more core areas of semi. We know that AI is, the innovation story, but you're seeing some recovery in some other areas. And so we do think that there's some more upside to tech.
Nadia, thank you. Nadia Lovell, hydrated at UBS. We appreciate her effort this morning. Blake Gwinn joins now. RBC Capital Markets on Apple CarPlay and on YouTube, Bloomberg podcast. Blake, let me go right there. The real yield out to 2%. What does that signify to the Federal Reserve?
Well, I mean, I think, this is part of why we had been talking about cuts to begin with, is really that they're looking at these real yields. They don't want a passive tightening in real yields as inflation continues to fall. Even if they kind of stay at that same rate, it just keeps getting tighter and tighter. So I think part of the reason we've been calling for cuts for quite some time is, not that we felt the Fed needed to get easier, more accommodative, but just because those real yields, if they do nothing to the nominal target, are just going to be getting tighter and tighter. So certainly something I think the Fed's focused on, those real yields, and that's part of the lens which they're looking at to deliver these cuts.
Paul, I got to go to Theo. I know Paul wants to jump in with some market moving questions. S&P futures plunging -58. The Dow futures down 320 points, and NASDAQ on a percentage basis down 1.5%. The markets move. You mentioned a passive restriction. Are we now restrictive because the market's saying so, or are we now restrictive because the Fed's dawdling around?
Well, this is a real question about what's restricted here, because I think part of what you're seeing over the last month is a little bit of doubt creeping into the to the Fed that they are actually as restrictive as they thought. I mean, how can you argue? We've been above what most people would have ex ante considered a neutral rate. We've been above that for a year now, and we're still seeing data this strong. It gets harder and harder to argue that you're well into restrictive if the economic conditions just aren't necessarily suggesting that.
So, Blake, are you in the camp that says May is a period where the Fed should cut rates? And if so, do you think they will?
No, we've actually for a very long time we've been in the June camp. So
okay.
This goes back to June and July last year. We have the same Fed call. We've kept it all the way through. We've been very steady. We see a June 1st cut. We have 4 cuts after that, so a cumulative 5 cuts for 2024. I'll tell you, this data today, NFP on Friday, it makes me feel more confident about the June part of that equation. I think this really brings into question whether they're going to have to do anything in May or whether they are going to do anything in May. Those are 2 separate questions, what they will do and what they should do. I think June certainly looks like the starting point where I'm starting to get a little bit worried about that call. Like I said, we've had it for a very long time, but, the 5 cuts is where I'm starting to get a little bit more concerned, because I think the inflation data alone in this kind of passive tightening we're talking about in real rates, I think that's enough on its own for the Fed to start cutting. But without any kind of signs of weakness or slowing on the growth or the labor side of the mandate, where's the urgency? I think, now you start talking about a scenario where, yeah, sure, you start cutting in June, but, are they going to go 5 times? Or are they going to take rates all the way back to, we have them going to 350 in 2025? That's the piece of it that I think starts to really get called into question here, is how aggressively they go and where do they end up stopping.
So, Blake, there are a lot of folks out there, both on the academic front and in the markets, practitioners that say the Fed's already behind. Look at the data. They should be cutting now. What do you say to those folks?
What data are they looking? I mean, we had a great NFP report. We had a pretty solid CPI report. I just think that this idea that cracks are showing that we're in problematic territory. I think a lot of times people tend to look at the delta. They look at the changes of how the day is changing. But when you look at the level of where we're actually at, I mean, across most metrics, we're still in a very healthy economic scenario. So I think going more slowly, making sure, the Fed just really wants to make sure that inflation dragon is really slayed. So
Gwinn, expand on problematic territory. What in God's name was that in Febosi? I don't remember that. Blake, expand on what problematic territory means.
Well, in what respects? For the data or?
I'm asking. I got an inflation report up. I mean, it's been up and away. This is what's called a mini correction. Futures down 57. I get it. The VIX 14.5. Forget about the stock market chit chat. Is this inflation report problematic for Jerome Powell?
Oh, I really don't think so. I mean, I think it certainly raises an eyebrow. I think the overall trend, you guys were saying before you came over to me, I mean, I think the overall trend is still positive. I don't think there's anything necessarily here that they're worried about a reacceleration. I think, we've gotten some decent proof, over the last 6 months, a year, that a lot of the inflationary pressure we were seeing, whether it was supply side, whether it was demand side, that I care a little bit less about those specifics. But looking at a whole, I think we can say that a lot of it was absolutely pandemic related. Like I said, that could be supply side, with supply chain shutting down. It could be demand side with, changes in the way people are consuming services, goods, et cetera. But either way, a lot of that seems to be pandemic related, seems to be idiosyncratic, and it has come off. So I think this kind of, the idea that we would kick off some kind of wage price spiral or that we were in some kind of new inflationary process, I think that window has mostly closed. I mean, certainly the Fed doesn't want inflation ticking back up, but I think, they're not looking at each individual print and overreacting too much. And I think the overall trend here is still positive for the Fed. I mean, they're not going to look at a minor beat today and start, raising alarm bells. I mean, I think, overall, they're very happy with where we've gone.
So, Blake, we've got the 10-year Treasury up 10 basis points here, 4.28%. Where do you think this 10 years going to be at year end?
So right now we have it at 380. So we do have that moving lower. I think, again, that was premised on this idea that they start cutting in June. They, cut at I'd say a relatively, moderate pace, going once per meeting. But that is the part where I feel a little bit less comfortable about. And now I'm starting to wonder, we have twos at 395. So we've taken out of our forecast just last week. We took out some of the kind of steepening that we had, that bull steepening that you tend to get on the start of a cutting cycle. If the data is this strong and the Fed goes on, if the markets are thinking about the possibility of an every other meeting type of pace, or they're thinking about the Fed cutting to a terminal rate of, 375 or 4% instead of 350, those front end yields are not going to rally in the way that we've been calling for. So we kind of have taken out some of that curve flattening and two's not rallying as much. So that's really where we're seeing some of the risk.
Got to leave it there. Blake Gwinn, thank you so much. Dan Ives promised me the market would never go down again. He was wrong. Joining us now from Wedbush, of course, ubiquitous with a bullish call on technology. We're going to focus this entire next 6 minutes with Dan Ives on Apple. Dan Ives, why is Apple lagged the others?
Because iPhone growth has lagged, right? I mean, this is something we've seen in China. The upgrade cycles have, I think, been better than many had feared, but it's not been iPod. And I think this is the start, what we've talked about, of the renaissance of growth that's going to happen over the next 12 to 18 months, where we believe Apple significantly outperforms even the rest of tech.
Is your reporting, Dan Ives, that the new iPhone that Paul Sweeney has to buy, Paul, for your family?
Yeah, absolutely.
Is a new iPhone an upgrade, or is it just another iteration of the one I got in my hands?
Look, I think in terms of iPhone 15, that's obviously just been an upgrade that's been strong from a technology around camera and speed. But the big one's iPhone 16. I mean, we've talked about it yesterday. Our checks are showing from a memory perspective, this is going to have AI technology built into the phone. I think
what
it's
does
the
that
start
mean?
of a
Stop. Dan, stop. What in God's name did you just say? What is AI technology in Paul Sweeney's phone?
So they're going to have essentially their own LLMs, their own language models built into the actual iPhone. So that's going to be for consumers to do all types of apps that they could actually launch, technology around animation. From a fitness perspective, it's going to create
the fitness card.
It's going to create a whole nother ecosystem for Apple, which we believe starts with the AI App Store that they're going to talk about at WWDC in June.
As an example, Paul, you can type in on your iPhone 16, should I spend $3,900 to see Louisville lose to Duke?
Exactly.
And you'll
or buy
get a
the screen
report.
Vision Pro, or buy the Vision Pro. Hey, Dan, we've got Apple, obviously a $2.9 trillion market cap stock. It's down about 3% year to date, and I would argue that I guess the investor concerns out there, if you could just underline one, it would be China. Give us your latest sense of China in terms of an end market, ultimate demand for Apple products going forward. What's your view?
Yeah, look, I'm not saying it's roses and champagne, but from a Lunar New Year perspective, we believe it's up year over year. And I think they're going to be able to actually return to growth in China, despite the Huawei, despite geopolitical, because you have 210 million iPhones in China. And there have been share gains. So my view here is right now, the New York City cab driver could be bearish in Apple. It's relative to broader tech as we expect, tech continue to move higher. But when we look at Apple, 2.2 billion, that's the active devices. Now AI is coming to the party in Cupertino, and we think a year from now we're at a $4 trillion market cap.
Hey, Dan, just looking at the FA function on the Bloomberg terminal, which has consensus revenue estimates for Apple over the next several years, kind of let's just call it mid-single digits. Yet I'm paying a 28 multiple for that type of revenue growth. How do you kind of square that? Is that something you have to convince your investor clients to kind of deal with?
Yeah, I mean, it's very similar to what we did with Microsoft or NVIDIA or Amazon. It's really showing that the services piece, that high growth, the multiple for that, and Keene and I have talked about this a lot. I mean, 1.5 to 1.6 trillion, and that's the monetization. Why Cook and Company? Right. There's a Mount Rushmore with Tim Cook and Nadella,
but Dan,
obviously from Microsoft.
If these guys are fanboys, I mean, if the CFO and the CEO are fanboys like Dan Ives, and they're looking at Apple behind over X number of months or whatever, do you see them doing strategic decisions like a new bond offering, an enhanced share buyback? Sweeney wants a dividend increase. What are they going to do with the use of the mother of all cash they've got, given that Apple's lagged?
Well, I think it's getting to a point they're going to have to do potentially some accelerated buyback, or if they don't do M&A, which has never been the sort of the DNA, obviously, Cupertino, they're going to have to do some capital allocation changes. And that's why it goes back to when I look at Apple from the sum of the parts, there's so much more that could go right than wrong, especially what's factored into the stock. And I think AI starts with the godfather of AI, Jensen, NVIDIA, and Microsoft. But it doesn't end there. The consumer piece is going to be 24 and 25, and Apple's going to be front and center.
Dan, you mentioned the developer conference in June for Apple, and oftentimes in the past, that's been a big catalyst for the company, for the stock. Give us a little preview of what we might see from our friends at Apple.
Look, and I'm sure Germer will talk about this as well. I think it's where they start to introduce generative AI from a developer perspective. I think it starts with an AI app store. That's going to be the first piece. And then that's going to lead into an iPhone 16 that includes generative AI exclusive to Apple ecosystem. And it starts that monetization, and I think even a further re-rating to where I see that renaissance of growth over the coming.
Okay, you're wired in this, Dan. I don't mean to interrupt, but I think this is critical. I get an iPhone 16 in 8 months. June, you said, so Labor Day, you get a new phone.
Yeah.
what am I going to AIEIEIO do? What am I actually going to do in AI on my iPhone?
So I'll just give you like an example. So you have a picture that you've taken on your iPhone 16. You now could actually superimpose you, Paul, at a Duke game, okay? And then basically take that picture, and it actually looks from an animation perspective that you're actually in the picture. And you can actually create movies from that. Those are examples of just a little tip of the iceberg in terms of the examples of what consumers, and I think Vision Pro, you're seeing some remnants of that, but that's what you're going to essentially be able to do in the iPhone in the coming years.
Okay, we're going to have to leave it there. Dan Ives, thank you for the briefing. We focused there for the entirety on Apple. That was a real luxury. He's got a lot of other capabilities. Today's front page headlines. Lisa came in. She was going to do an all-Taylor newspapers thing. I said, no. I'm done with Taylor. Start with something different, please. What do you got?
We will. We'll start with Jon Stewart. He returned last night, host of The Daily Show. You know, he's going to be on every Monday. So he returned. It was classic Jon Stewart style, right? He first answered the question on everyone's minds. Listen up.
Why am I back? You may be asking yourselves. It's a very reasonable question. I have committed a lot of crimes. From what I understand, talk show hosts are granted immunity, so it doesn't...
There you go. So he kicked off the season. He did that show's signature franchise indecision election coverage. He talked about, yes, Taylor Swift, the Super Bowl, conspiracy theory surrounding it.
Right.
But he's back in full force. I'm curious to see how the ratings...
Paul, help me here.
Yeah.
Did you just say he's on only one day a week?
Mondays.
Paul, I don't get this. I mean, you know, the wonderful Rachel Maddow's doing the same thing, and many others out there. How do you build a franchise if you're as inept as I am? You can't do it one day a week.
I think he's already got the franchise. This is throwing a bone into the network and say, hey, we'd love to have you as much as we can get you. I'll give you one day a week, and we'll do it through the election. So that's his gig. He's going to do it through the election. So it's not a long-term thing. It's just a play.
I don't get it.
And I'll tell you, TV is so desperate for any relevance. Broadcast linear television is, so desperate for relevance.
Which networks he on?
And they haven't had much. He tried to get something with Apple TV going. Apple.
But I'll tell you, his show. I listened to I watched the show this morning. It's the exact same as it was, which is exactly what you want, I think.
But it's what brought it to that success in the first place.
Right. So anyway, he's back for a little bit.
Next.
All right, who do we got? Tiger Woods. Yes, we talked about it. Michael Barr mentioned this. Moving on from a split with Nike, launching a new apparel line. Now, Paul, you're the golf guy, so he's going with tailor-made golf.
Got that right.
Sunday Red, that's what it's called, because he wears the red, on Sundays for the final round of tournaments. But it's like an ongoing relationship. He joined them back with the brand in 2017. Like they started this, partnership. He's already playing with their golf clubs.
Yep.
So it seems to be a good partnership. That's what they're saying. That they're going to make decisions together. Like it's back and forth. Are you TaylorMade fan?
I use TaylorMade woods.
You
I
do?
use Callaway irons. TaylorMade's a great brand, but it's no Nike. I was surprised to see the Nike Tiger Woods split on both sides. So I guess this is just a question of, I don't know, who's got equity ownership and does he have more say over what's going to be done here? And Nike had backed away from golf a little bit.
I think of the great Miller Barber who just kept going. I mean, you had the senior course and just kept going and going. Is Tiger Woods now a senior?
Not quite. A couple years away, but he's still by far the number one driver of anything golf.
So he's still on the circuit, even with his terrible injury.
Yeah, he's playing this week, for example, out in Los Angeles, because he's the sponsor of this week's tournament.
I got 30 seconds, Paul. The drunk kids on the golf course.
It got just went over the edge. I mean,
over the edge.
Just over the edge, and it's out there in Arizona. It's a great tournament.
Waste
it's a great
management
week.
tournament.
The waste it is,
yeah.
and it's a big party, and they just went over the edge. Over the line this year. They got to pull it back a little bit next year.
They got to pull it back right away. One final story there, Lisa Mateo.
Taylor Swift. Got it.
There you go.
Come on, Bob.
I'm gonna do it for
Discipline
you.
her.
Okay, here's the thing. They put a price tag on her airtime during the Super Bowl. She was on for 53 seconds. Okay, so if
of a 4-hour broadcast.
So if you factor in the cost of a 30-second commercial, right? $7 million. That airtime was worth $12.4 million.
Yeah, and so for the people that are complaining that she gets too much airtime, it was 54 seconds and a 3.5 or 4 hour broadcast. Lighten up. And it was great for CBS. They're happy because it brought in more viewers, record viewership. Everybody's happy.
Yeah, even she attended the game for free.
Can I just say, there is a videotape out there on YouTube. Thank you for watching on YouTube, Bloomberg Podcasts. And one night at a place called the Bluebird Cafe in Nashville, and this happens all the time. One night Steve Tyler from Aerosmith came out of the audience. This blonde comes out of the audience and picks up a guitar. And she sat on a stool without any of the modern hot air, and she blew the room away. Just the chops, just the ability. I think all of that has been obscured by all this. Who's she seeing?
Travis
She's seeing Joe Montana.
Yeah.
Travis, whatever.
Yep.
Go look at the Bluebird Cafe video of Taylor Swift with a guitar in her hands and nothing else. And it's, I'll say that it is just beyond impressive. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.